freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here with Adam Penn. Hi, Adam. How you doing?
Hey, Dustin.
I'm trying to figure out new ways to say that to make you laugh.
Say my name.
Yeah.
Well, at least you didn't have the Adam Penn who's stupid part like you did in the beginning before we hit recording.
Yeah. No, the dress rehearsal was slightly different. I decided
I'm glad that won't make it onto the recording anywhere.
Yeah, for sure.
I went and got a Christmas tree this weekend. Cut it down myself. Well, I used a chainsaw, like a little M18 Milwaukee chainsaw.
Yeah.
Yeah. It was
Did you just like pull up to a
10
random
fingers?
Like you pull up to a random spot on the side of the road and just saw down a tree?
Yeah, that's what I did.
Okay.
No, I went up to the Lassen National Forest. You get a permit. It's $10. You can cut up to a 20-inch diameter.
Interesting. Okay.
Which is a massive tree. So you can basically
cool.
cut anything.
Yeah. And you made it back with all your fingers and toes and didn't accidentally slice an arm off. That's good.
We got 4 trees, 2 for my buddy and 2 for us.
Good. Well, this episode is going to be airing after Christmas. So obviously we can tell when this is airing, but it's good to know that, you got it. Do you always get a natural Christmas tree? Is this like a tradition?
Yeah. Always go cut them.
No, that's nice.
Yeah.
It's very pleasant.
They smell like pine.
Yeah. You get to enjoy the smell in the house and all that stuff.
That's and they burn like hell when they're dry.
Yeah. Sorry. Have you seen Christmas Vacation, National Lampoon's Christmas Vacation? Okay. So there's just, as you're sitting here talking about all these things, I'm just thinking of different scenes in that movie. You need to go watch that.
Okay.
As Clark Griswold cuts his own tree. And
we should get into the interview, but I have another note that we had an investor invest in our oil deal last night, and she's like, "You guys sent that video, and it was like straight out of Landman, the one with the oil spilling out." And it's it's just, I thought it was a Landman episode.
It's very true. No, it's that's a complete aside to this episode and everything else, but it is pretty neat. We're excited with this new operator we're working with, and they're sending us videos like literally straight from the field, like with them running their hand through like flowing oil.
I don't think you had to touch it to make the point.
Yeah, exactly. This is not AI. He's actually there. Well, on a completely different topic, we have, I think, an awesome guest joining us today. I'm pretty excited about. I can he sent over a bio. I can read that, and that'll kind of set the stage for everything. But today we are interviewing Ian Colville, who is the founder managing partner of Carpathian Capital Management, and I think he goes through this. We'll talk to him, but he talks about Carpathian is spelled Carpathian. So if there's any question there, you go to look that up. That's how you spell Carpathian. But Carpathian is an alternative asset manager specializing in U.S. residential real estate development. And since launching the firm in 2012, Ian and his team have overseen more than $400 million in residential assets. And Ian's got an interesting background. So he began his career in management consulting before spending a decade in emerging market investment banking, serving as the head of equity sales for Deutsche and Citigroup in Moscow, advising institutional investors on Russian opportunities in the mid 2000s. Very, very interesting time to be in that space. But that experience forged a unique perspective on risk management that he later applied to the U.S. real estate market. And after a brief stint as the CEO of Dream House Ukraine, which was then the country's largest wood frame construction firm, he returned to the U.S. and founded Carpathian. And Carpathian distinguishes itself by applying institutional-grade analytics, proprietary AI-driven operational tools to middle-market real estate deals, often overlooked by larger funds. As for Ian, he holds an MBA from Wharton, Master's in International Studies from the Lauder Institute, and a BA in Economics from Carleton College. He's fluent in Russian and speaks regularly on risk management, private fund liquidity, and the practical application of AI in asset management. So we're very excited when we were able to book Ian and excited to dive into the interview here. So Adam, unless you got anything else to add, we'll just dive straight into it.
Nope.
All right, let's go.
Well, Ian, thank you for joining us today. There were a few technical difficulties before the show started, so we've all got a little bit of a smile on our face. But why don't you tell our listeners a little bit about yourself and what what your company does and what you'd like to talk about today.
Thank you, Adam and Dustin, for having me. I'm Ian Colville. I run Carpathian Capital. We are in Minnesota, and we've been investing in the residential real estate space for the last 13 years or so. Before that, I was in investment banking. So what we do is we manage about $150 million of real estate assets on behalf of our various investors. We got started by buying houses back when they were cheap. I think at our peak, we had something like 450 houses. We still have a couple of hundred of them right now, but we're slowly winding down that portfolio, taking our profits and sending money back to investors. But we've got a big housing shortage. And so as home prices went up, we added on to our business, and we have a private lending business. So we have about a $50 million loan book. We lend money to make construction loans to home builders and rehabbers. That's just in Minnesota, where we're based. And then for the last 5 years, we've been investing in residential developments, and we do that via a joint venture equity model. So we find markets around the country that we like. We find developers that we like in those markets. And then if they need capital, we look at the projects that they're proposing that we invest in. And all that fits together, and there's something that we like, we'll propose a joint venture or something along the lines of, we put in 80% of the equity that's needed for a project. The partner puts in 20%. They do, most of the boots on the ground work. We do a lot of financial oversight. As there's something to sell, as something gets sold, and I'll describe some of them in a second, the money comes back to our fund, and we either reinvest it or send it back to investors. So there we do business so far in 4 different states. We've got a 29 town home community going up in Cincinnati, which is a fascinating market. It's one of the tighter home markets in the country. We're on our third project in Atlanta, Georgia, with a really great partner there. We've got a few land development projects in Florida, and we've got a 200 home community age target going up here in Minnesota. We're about halfway through that. So a lot of things going on.
Yeah, sounds like quite the busy book of business. So you mentioned briefly that you kind of came out of the finance space, which makes sense how you're running such a large company, but a lot of people in the syndication space, real estate investing space, have some type of other background. You meet a lot of doctors turned syndicators, or I was a software engineer before I started investing. So tell us a little bit about your finance background and how that's helped you kind of build this career.
Well, I understand the numbers and the money real well. If you ask me to swing a hammer, I won't have any idea what to do. So I've got strengths and weaknesses, but we have a team of 11 people here that understand what we're doing in a deep way. So yeah, my background was, I'm from Rochester, Minnesota, a reasonably small town. But somehow after I went to business school, I went off on a 10-year trek to Russia. So I worked in investment banking in Moscow, Russia in the early 2000s. I ran equity sales for Deutsche Bank, which is a big German bank. So we ended up speaking to Western investors about Russian stock investments. And then I ran equity sales for Citibank as well. I left in 2012. And that was a very good decision. But just after the housing crisis, houses were cheap. So I would come back and see a hedge fund client in New York or something. And while I was back, I'd buy a $30,000 house for my own portfolio. So by the time it was time to leave Russia, I had 6 properties in a 12-unit apartment building. I called that a track record, and then I went out and raised money from people I knew from my banking days. So I guess what I bring to the table is a real solid understanding of the numbers, the cash flows, how things need to be structured in order to actually make money for investors. And we have other people on the team who evaluate things like, is this the right market to be in? Is this the right product type for this particular area? How much can we expect to get from the properties based on comps, et cetera?
So this is somewhat tangential, but I'm definitely very curious now. Who were the Western buyers of Russian equities in the 2000s? Like that seems like that would be a very hard sell.
It's a controversial and hard sell now. But back in the early 2000s, we were coming off of pretty chaotic years under Boris Yeltsin. The fall of the Soviet Union was in the early 90s, and Russia was clawing its way out of the aftermath of that. But Russia is an oil and gas rich country, so they have a lot of natural resources. And as the market economy opened up, there actually were lots and lots of investment opportunities that lots of Westerners were interested in looking at. We wouldn't be talking about individual investors generally. We're talking about sophisticated mutual fund managers or hedge fund managers or pension funds, et cetera. But in the early 2000s, the oil price was going up just about every day. And as each time the oil price goes up, a little bit more money comes into Russia. So, and they didn't have much. So we're talking about like the first mobile phone company and then the second mobile phone company and the grocery store chains that they never had before. So things that we take for granted were all being built from scratch there. And when there's nothing, you go from nothing to something, it can move pretty quickly. So there was actually a lot of Western money involved. Not so much anymore. It wasn't a hard sell then. It absolutely is now. And for good reason.
What was I not to like completely take us down this tangent, but I'm super curious here. Like, what was the risk profile for that? I mean, were these viewed in obviously I wasn't in the financial realm during that time, but like, what was were these viewed as risky investments? I feel like, you have some large mutual funds that would be buying into this. I mean, was that for more of their like, oh, here's our like high growth portfolio. Like we're going to add that there. Like where did this fit in like a risk perspective?
So we were typically talking to the emerging markets portion of an asset manager. So this wouldn't be like the same fund or same bucket of money that they're buying shares of Microsoft with. We're international stocks, and then emerging markets is a very specific sort of subset of that. And if you're well allocated, you might have 20% of your portfolio in international stocks and 80% in the US. And then some portion of that 20% might be in emerging markets. So it added up to big dollars for Russia, but it doesn't necessarily mean that we were taking over, 80% of somebody's portfolio or with these wealth managers. So all of the big ones are Fidelity, have emerging markets, funds or allocations, State Street, very, very large pools of money, but, a smaller portion of that money. So at the time, Brazil, Russia, India, and China, the BRICS countries, as they were called, were places to invest in the emerging markets. And Russia made a lot of people a lot of money in those years. Not so much anymore.
Okay, that's my curiosity tangent is over. I appreciate that.
Yeah, my pleasure.
I'm glad you got your questions answered. Going back towards some of what you've done kind of in the real estate markets here in the U.S., a lot of times, and I don't tend to believe it, but you hear a lot of people saying they're too late or things are too expensive now, and they're going to wait for the next big crash or whatever it is. What are they getting? What are people getting wrong about the current housing market?
All right. So if you're hoping to buy a house and have it, double in value, you're definitely too late for that. But there's a big shortage of housing in the United States. We're nowhere close to where we were back in 2008. So when I talk to our investors, I like to show them this chart of here's the long-term household formation rate. It's something like 1.2 million new households formed every year over the long term. It fluctuates each year. And then we tear down something like 300,000 houses in the United States. There's arguments about what the right number is there, but in that ballpark. So roughly speaking, we need to build 1.5 million new homes we need to have 1.5 million new units of housing every year just to keep up with the households that we're forming. And then there's a nice, so that's a flat line. Then I have a chart where there's a nice, like, hey, we were building way above that before the housing crisis. Then we necessarily crashed well below that, down to, I think it was like 300,000 or 400,000 homes per year. And that was necessary because we had overbuilt over here. And then so we had to underbuild for a while. But then you get to around 2012, when home prices started going back up again. And there remained an enormous gap between the household formation rate and the rate of construction. And we've only, just before interest rates started going up in 2022, we only barely got back to the running to stand still portion, where we're building enough to keep pace with current household formation. But over the previous decade or so, an enormous shortage had built up, and we've never gotten to the point of dealing with that shortage. So that is structurally still here. So there's an opportunity, if you can get the right sort of value proposition in the right markets with the right financing terms put together, there's absolutely an opportunity to sell homes to somebody. Buying an existing home and hoping to squeeze a whole lot more money out of it can be a challenge, but there are rehabbers that can find off-market deals and do that well. But I think most of the opportunities bring new units of housing to the market. That could be multifamily, it could be single family. There's a structural shortage, and we're not dealing with it yet.
Go ahead with your other curiosity.
No. I'm trying to phrase a question here, because there's obviously a lot of housing doomers, right? That
Sure.
you see online. What's his face? Nick Girelli, I think, of forget what outfit he's with. Melody Wright's another one that I see on Twitter often. I actually think she just did a interview with Adam Taggart and was she's predicting the crash, right? She's been predicting the crash for the last 5 years.
Was this 50% drop in housing prices?
I think so.
I believe I saw that just recently. Yeah.
And I mean, I tend to not buy that for the reasons that you just said. I feel like the structural shortage, in the end, I feel like supply and demand wins out over all of these other concerns. As long as there's a shortage of housing, that's going to provide a floor. I guess the question in this is where, how do you see a lot of the doomer prognostications and the predictions, and they're always they're early, right? They're just wait. I guess what's sort of your take on that, and sort of how you look at the data? Obviously, the same data they look at, but come to different conclusions.
I don't remember. Each time I see a story like that, there's different arguments being made. A legitimate argument is affordability. So the price of a house relative to income at the moment is we're at the high end of what is affordable for people. So until interest rates, each time the interest rates drop, that adds to the affordability. But there's a fair amount of buyers sitting on the sidelines right now, I think, who would love to buy a house, but they haven't been able to find something that meets their budget. So that can be aided in a few different ways. You can have a lower interest rate, or you can bring lower cost housing to market, or they can just sit on the sidelines until their income is sufficient. But unfortunately, I think we're seeing a fair number of people not able to get on the housing ladder right now because things are not affordable. That doesn't mean the demand isn't there, however. So just the market is, since interest rates went up, the market is absolutely moving at a slower pace than it was in early 2022. The volume of transactions, but home prices have kept going up, even though we saw the fastest run up in interest rates at any time since the late 70s and under the Volcker Fed. And that's a testament to the extent of the shortage. Home prices going up at a slower pace than before, but still going up nationally. We may be in for a period of flat home prices. I think they are falling in some markets around the country, but I expect that to be fairly modest because of the shortage issue. But yeah, that affordability is an issue, and that can arguably can be caused by a variety of things. It's expensive to build a home these days. It's expensive to get the city to approve your development. It's expensive to finance them. So a slow market where affordability is an issue. I agree with all of that. I just don't agree that we're heading towards a crash because those things are real issues.
I think maybe taking a little bit of, almost switching the conversation a little bit, but still staying on the side of issues. You talk a fair amount about underwriting and even using AI for due diligence. Do you want to maybe give us a brief intro into some of your thoughts around that?
Yeah, if you're going to invest in real estate, you're often talking about making some sort of a private investment. You might be doing it yourself, or you might be trusting somebody else with your money. But especially in the residential space, oftentimes you'll see a small or mid-sized syndicator saying, I'm raising $1 million to do this, or I'm raising $10 million to do this. And their due diligence really matters. I teach a course on due diligence for private investments, and I teach that to wealth advisors that can get continuing education credit for attending. And there we go through a lot of like the people, the finances, the people, finances, and but 4 or 5 other things, how to read a PPM. I spend a fair amount of time explaining what deal terms look like in a private investment. And that's where I oftentimes see question marks come up. These advisors send me deals that their clients are being shown. And there's some that are fairly typical and fair, and there's some that have made me just fall out of my seat. So in addition to like deciding if it's a good deal or not, you also have to decide if this is a good manager and these are good terms. I'm happy to talk about any of those buckets. And I can tell you some of the worst I've seen or what I think is fair.
Dustin, you're nodding your head. You got a direction you want to go with that?
I'm curious. I mean, we could spend, I feel like, hours talking about all those, but I'm curious, Ian, the AI aspect of this and sort of how that's transformed a lot of this. I know, Adam and I make use of it for things that we're looking at for passive deals that we get, right? Like I've started pumping PPMs and everything into it and asking questions. But so I'm curious from your point of view, how you've been using that, and then what you've seen that, passive investors can be using to improve their due diligence processes. Yeah,
I can just talk about how I've used it in the due diligence process. I use it in all kinds of things, but specifically in due diligence, course attendees, I give them a checklist of all the things that I think one might want to check. It's about 70 things inside of 6 different categories, and there's about 70 different things that I would check. Maybe 60% of that information can be found in a PPM and a marketing deck. So I did a decent amount of work to get AI to cooperate with me to do a good job of pulling out quotes from documents that I uploaded to that contain the information that would help me answer each one of those questions. So like populating a spreadsheet with the quotes from a PPM on a marketing deck is now fairly easy. The analysis of what that means is where there's still a fair amount of human expertise and intervention. But AI there, especially if you're a novice investor, can also get you started. What do I need to be aware of in this deal? What terms are not market standard? What questions might I want to ask? What other things should I be checking? So I can, if somebody sends me a deal, I can get the spreadsheet populated pretty quick on here's the things we need to look for. Here's the citations. So if we want to go back and reference, which page in this 80-page document. But then I will do a lot of manual attention to how are the profits being split? What fees is the sponsor charging? Do they have a big enough team to get the deal done? What happens if the key person gets hit by a bus? There's some thinking involved, and I'll add my opinion on all of that. But even if somebody is a novice, the AI will have an opinion for you about what a good waterfall is, or is the sponsor charging too much in fees off the top so that their incentives are misaligned.
Yeah, that's really good. Adam, do you have any follow-ups there?
Yeah. So From the standpoint of due diligence, and you've touched on a handful of different topics and things that you say you have a checklist, which obviously we can link in the show notes below.
Yeah, happy to.
A list of 70 is a lot, so there's probably some key items that you think of. Is there anything kind of on the high level that it gives you a quick no?
Yeah, I mean, you can, rule of thumb, has this deal, the person who's asking you for money, have they done it before? Believe it or not, that's not always the case. Or the person has done something adjacent, but not this thing. So they may have had some experience repositioning a market rate multifamily building, but they don't have a lot of experience building a multifamily building. Or they might have a fair amount of experience building a multifamily building, but they don't have a lot of experience building and managing a senior living facility, which is a more complex type of an operation where it's not just regular property management. It's all the things that come with the senior living niche. So does the sponsor have experience? That's a real easy one. Another real easy one is how much money, is the sponsor charging in fees? So you want to have the cash flows. You want the sponsor generally making money when investors make money. But if the sponsor is charging a 9% of equity acquisition fee, which is a deal that I just reviewed, almost fell out of my chair. If the sponsor is raising $10 million, but taking $1 million on day one for their as their acquisition fee, that's the sponsor getting paid no matter how well or poorly the deal performs. So some amount of fees are reasonable and make sense, and there's a different amount that don't make sense. That's an easy place to look. And then the profit split on the back end. Generally in these types of deals, you'll see investors get some minimum. The investors get their capital back and some minimum rate of return, often called a hurdle rate or a promote or a hurdle rate is pretty typical, or a preferred return. That's the other term I'm looking for. And then the deal sponsor, after they've satisfied those things, the deal sponsor is eligible for some percentage of the additional dollars that are coming off of a deal. Something up to 20%, sometimes 30% if it's really an excellent sponsor. And then the 70% going to investors. That's within the ballpark of standard and worth looking at. The worst deal I've ever seen was 90% of those dollars were going to the sponsor and only 10% to investors. And in that particular deal, the sponsor also had the right to buy out the minority investors by giving them a flat 8% return. So these aren't typical, but these are the types of things that I see. So, you want to pay a lot of attention to those.
Very interesting.
Those things. Yeah.
I'm curious, what are your thoughts on, we've seen some pretty complicated deal structures, but we've also seen some really simple ones, things of like a no preferred return and just a straight 80-20 split with maybe a 2% acquisition fee.
Yeah, I have an opinion on that one in particular. The deal I was looking at the day before yesterday, where the sponsor was taking that 9% of equity fee. Let me make sure I'm not getting my deals. It also had a no preferred return and a split right from the beginning. That changes incentives in the sponsor's favor. What it means is, even if investors are involved in a money losing, it depends on if the first chunk of cash goes to paying back investors their initial capital. In this particular deal I was looking at, it was a straight 90-10 split from day one. If investors put in $10 million and the deal only paid out $500,000, the manager was still going to get $50,000 of that $500,000. So there, I think the incentive, while a 90-10 split sounds good, it's not an 80-20 split. The fact that the sponsor was getting paid right away, I think, outweighed the the benefits of a 90-10 split. So, it is sometimes hard to explain to investors, well, here's how preferred returns work, and here's how the cash is going to flow. So there's something to be said for simplicity, but I don't think simplicity to the extent that it really doesn't keep investors' interests in mind is worth it. I'd rather go through the explanation process.
I would agree with that. There's a balance to be had, right? Like you gotta, and Adam and I have heard people who think that like, unless you've got, 5 different levels to your waterfall and it's all these complicated things that like, then you shouldn't be investing, because obviously if you don't have that sort of waterfall structure, you're not sophisticated enough. But at the same time, you can't overdo it that way. And then if it's so simple that the incentives are now for whatever reason misaligned, then that presents another problem. So
I have a comment on those multi-tiered waterfalls. I wouldn't assume that a simple waterfall means someone isn't sophisticated. For instance, when we invest money in deals with our developer partners, sometimes our deal is a straight up, we get all of the money until we've gotten our initial investment back, plus whatever is necessary to get us a 20% IRR, and then we're done. So an IRR is like a compound annualized rate of return. So in this context, you can think of it a little bit like functioning like an interest rate. So, sometimes we're like, all right, we flat want to make this much money, and after that, we're done. If we do a regular waterfall, there might be one level to it, or there might be 2. We rarely do something like 5. We're talking about like developers who develop 1,000 homes a year, 2,000 homes a year, that they don't want to be dealing with that complexity. So it doesn't mean that keeping things simple is not necessarily a sign of no sophistication.
We recorded a podcast episode on that, and because we know plenty of like very successful investors who have maybe a preferred return, sometimes, most of the time not. Their baseline's an 85-15 split, and that's basically every deal they approach. That's just how. Do
investors get their capital back first?
Yeah,
if on a sale, but cash flow is initially all cash flow is 85-15, and then if there was a sale, then they would get returned of capital first. So no equity depletion.
So 85-15 is a decent percentage. I would, if I were reviewing a deal like that, I would look real closely at the sponsor's track record. And the sponsor has a solid track record, and they can document and prove out the returns they got to investors. They've clearly got some operational expertise. I wouldn't necessarily say, don't invest. Just be aware that the sponsor gets some money before investors have gotten their initial capital back, and sure, maybe that's worth it.
Yeah.
So,
for sure. Well, Ian, want to be mindful of time, and one of the questions we like to ask all of our guests. We're the Wealth Independence Podcast, and so the words independence and freedom are important to Adam and I, and kind of how we live our life. So we like to ask, what do those words mean to you, and sort of how do you live them? How do you manifest that in your everyday life?
I think the fact that I'm running a business instead of working for someone else is a product of me having a healthy aversion to authority. I never really liked working for other people. I did it responsibly. I did it well, but in some years I'm not making as much money as even some of our employees or our investors, and in other years I do better, and I'm willing to. That's a fair trade-off for me to wake up in the morning and say, all right, today I'm making my own decisions about how I spend my time and what I do with my life. So I think about that quite a bit, actually. I just feel better when I can be making my own path.
I think that definitely resonates with both me and Adam for sure. So that's awesome. Ian, we appreciate you being on. How can folks stay in contact with you if they want to learn more? Where can they go?
Yeah, hopefully I can put like a website in the show notes.
Absolutely. Yep.
So Carpathiancapital.com. It's a little hard to spell Carpathian. It's a mountain range in Eastern Europe. So if you need to look up how to spell Carpathian, it's Carpathiancapital.com. There you can just push on the button and find me. You can see what funds we offer. So I would love to hear from people. Yeah, and if somebody wants to take this due diligence course, it's free. So I use it to meet wealth advisors, but it costs me nothing to have other people attend it. So please.
That's great. We'll make sure links to both of those end up in our in our show notes for sure.
Excellent.
Yep.
Thank you so much for your time. This was a lot of fun.
Yeah, we appreciate you being on. Adam, any final questions or closing comments?
I appreciate it, Ian.
Yeah, I got the sense we could speak for 3 or 4 more hours.
Yeah.
Very easily.
All right, gents.
All right. Thanks, Ian. We appreciate it.
Thank you.
Well, I thought that was a great interview. One of the things that stood out to me or was an interesting topic for conversation, because he has seen so many deals, and it sounds like maybe he even does more deal reviews of other people's deals, is some of the conversation around splits and the way that they, analyze them, what he thinks is, quote unquote fair, and just kind of the way that everyone looks at it. Because like we've talked about a lot, there is 10,000 ways to structure a deal, and we do what we think is, once again, quote unquote fair, but there's always a possibility that someone will have a different view on it.
Yeah, no, I mean, he's definitely got the experience and, it has seen a lot of stuff. And I think the experience outside of real estate, right? I mean, I kind of had my curiosity tangent talking about selling Russian equities to Western investors in the early to mid 2000s, which is just kind of fascinating to me. But I do think that can definitely produce a different view on things, right? Whereas if you've never had sort of that view, I mean, that would have been maybe not as risky as we think about it now, but that's definitely, I think as he said, that's not the core part of your portfolio, right? Like that ends up being a little bit more of the large equity growth play. And so knowing that obviously impacts the way that you look at risk.
What we didn't talk about a lot, but was interesting, is he is specialized in single family, right? Not a whole lot of people do that. And so I think that was an interesting market play, right? Because he's not coming in here and trying to go develop multifamily or buy large buildings. He is doing development and finding a good way to do those. So that was interesting, and it's sad that we didn't get him to speak Russian at any point on the call.
We should have asked, shouldn't we? We didn't even think about it. No, I mean, I feel like the conversation could have gone I think we even said this during the interview. We probably could have talked 2 or 3 hours just with his experience in different things. But I do think that's a good point about him being focused in the single family space. And I mean, there's a lot of discussion about that right now. And kind of, as I mentioned, you got a lot of doomers and people that are predicting the downfall and that there's going to be a major housing crash. And obviously that space would be, I think, more, if that were to happen, that's going to be more impacted than the commercial side. But at the same time, I don't, the stuff he's looking at, he's obviously further into that than we are. As we talk so often, so much of it just comes back to supply and demand. And as long as that demand element is still there and we are undersupplied, it's really, really hard to come up with. I mean, we can come up with a bunch of reasons for why it's going to crash, but ultimately none of them matter in the face of low supply and high demand. That tends to override everything else. And that's not just single family, right? Like I've written about this a lot in the newsletter, that any market, anywhere you can find, if you can find something that is in high demand and there's low supply and you can supply it, you're typically going to do pretty good for yourself.
Well, I hope everyone enjoyed it, and feel free to reach out to him. Contact information stuff is in the release notes below.
Yep, we'll have it all down there, and we appreciate everybody listening. If you like this, do all the stuff, give the thumbs up, leave a positive review on Apple Podcasts, all the things. Let the computers know that you are enjoying this, want to see more of it. We would very much appreciate that. But Adam, unless you got anything else, we'll get on out of here.
No, sir.
Sounds good. Well, again, we appreciate you listening, everybody, and we'll catch you on the next one. Just remember, where freedom leads, where wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.